Hello, ladies and gentlemen. This is Thomas Fross here with Fross and Fross Wealth Management with your weekly market and economic update for the week of December the 21st, 2020. As always, please make sure you read the disclosures that were attached to the video or to the email rather that sent this video out. Or if you happen to be watching on social media, just simply go to lplresearch.com. You can read any of the disclosures that you might find therein. So it's starting to sound a little bit like a broken record. Not a bad one, but the same old though. Stocks continued their rise last week, bringing all the three major indices to record high levels. But it was the same old that were the causes. It was fiscal stimulus, optimism, and a positive long-term outlook because of the vaccine rollout. Shocker, right? Here's what's different though. Long-term treasury yields rose last week and oil prices continued their increase. Now they've gone up for 7 straight weeks in a row. Now, in other news, mixed economic data is hinting that the recovery is slowing just a little bit as positive cases rise and more stringent restrictions are being put into place. Additionally, and despite the Christmas shopping season, retail sales and job growth weakness increase the focus on a need for Washington to come out with more fiscal stimulus. And while we've been talking about additional stimulus package for way too long, it looks like Congress actually finally came up to an agreement on a relief package that will put about $900 billion back into consumers' pockets that hopefully find their way into the economy and ultimately also into the markets. At Fross and Fross Wealth Management, we believe that this deal could provide the much needed support to buoy the economy to get us to the other side of the pandemic. All that being said, we're just going to bottom line it for you in the face of new information that emerged last week. Number one, it's apparent to all that the economy is not going to be unscathed after yet another round of upticks of COVID-19 cases. And while the current difficulties may be temporary, we don't expect to see recovery momentum advance until well into 2021. And remember, we've continued to say that this problem is not going to be fixed in a straight line, that we expect there to be a lot of bumps in the road. Number two, in our view, the Fed's announcement last week signaled one thing, and that's that monetary policy will remain extremely accommodative for much longer than the government's ever kept it during previous recoveries. And the markets tend to really like additional stimulus. They love the expression, don't fight the Fed. Well, we believe that 2021 will be no different. And number three, fiscal stimulus will add a much needed boost to the economy next year, and we're glad the deal was made in Congress, which will help support consumer spending and labor market conditions over the next several months. So all this being said, our view remains that the fundamentals support a long-term positive outlook. However, and warning, another broken record here, there will be turbulence in the way of volatility as we trudge down the road of recovery. We expect an economic soft patch in the near term without a full-fledged market downturn though, and a vibrant return to recovery momentum in mid-2021. And that is all fabulous news. Well, if we don't get a chance to see you before the holidays, please be careful. If you happen to be traveling, please be careful. We look forward to seeing all of you very soon. And on a personal note, I cannot wait for 2020 to be over. Have a wonderful day.